With AI reshaping industries, electric vehicles racing forward, and data centers computing power soaring, it's a pivotal moment to assess whether stocks like Nvidia, Palantir, AMD, Tesla, Alphabet, Amazon, and Apple deserve a spot in your portfolio. Together, we'll unpack each company's story, dive into their financials, weigh the rewards against the risks, and map out practical steps to make informed decisions, all delivered with clear insights. Welcome to the Fortune Signal, your headquarters for smart, strategic investing. Just a reminder, this isn't financial advice, just smart signals to help you think differently. Before we begin, please make sure that you like and subscribe. Let's dive right in, starting with Nvidia, the AI powerhouse that's been both a trailblazer and a lightning rod. Nvidia's GPUs are the heartbeat of artificial intelligence today, powering everything from generative AI models to immersive gaming experiences. They've built an empire, but April 2025 threw them a curveball. The US government tightened export restrictions on Nvidia's H20 AI chips to China, effective April 9th, hitting the company with a $5.5 billion charge tied to canceled orders and inventory write-downs. China accounts for about 17% of Nvidia's revenue, according to Bloomberg, making this a major blow. The new export rules were stricter than expected. Even though the H20 was designed to sidestep earlier regulations, the latest measures, reported by Reuters, caught analysts by surprise. Nvidia's response has been measured. CNBC quoted the company affirming they follow export laws to the letter, handling this geopolitical hurdle with precision. An April 17th Argus research note adjusted earnings forecasts downward but reaffirmed Nvidia's dominance, highlighting their technological edge and massive global customer base. Nvidia AI infrastructure and data center solutions remain in sky-high demand, not just from tech giants but also from a wave of startups. At the time of making this video, Nvidia trades at $111, with a staggering market cap of $2.74 trillion, per Yahoo Finance. Analysts overwhelmingly agree. Stock analysis polled 43 experts, nearly all rating it a strong buy, with an average price target of $169, ranging from $120 to $220, suggesting a potential 52.7% upside. At a forward price-to-earnings ratio, PE, of about 30, based on this year's projections, Nvidia looks reasonably valued for a company growing earnings at 20.6% annually, according to Simply Wall Street. So, what does this mean for your investment portfolio? Nvidia's recent dip could be a rare opportunity to buy a premium stock at a relative discount, especially if you believe AI's influence will only keep expanding. But risks remain. US-China tensions could worsen, and semiconductor supply chain issues, as Reuters warns, are still very real. Next, let's shift gears to Palantir, an entirely different beast, less about hardware, more about turning oceans of raw data into actionable intelligence. Palantir's platforms, Gotham and Foundry, help governments and corporations navigate complex decisions, and they've been gaining serious momentum. A multi-year US Army contract alongside partnerships with Google Cloud and Anthropic are supercharging Palantir's AI capabilities. In early 2025, they reported Q4 earnings, $828 million in revenue, up 36% year over year, with US sales alone jumping 52%. For the full year, Palantir hit over $2.8 billion in revenue and 41 cents in adjusted earnings per share, beating Wall Street expectations, according to Business Wire. One red flag: CNBC's April 25th report highlights Palantir's heavy use of stock-based compensation, which can dilute shareholder value. Another red flag is the company valuation. Palantir trades at $112 with a $250 billion market cap, per Yahoo Finance. The trailing price-to-earning ratio is a jaw-dropping 593. Competitors like Snowflake and Databricks loom large, and compensation practices remain a sticking point. Palantir is like a high-speed bullet train, electrifying if it stays on track, but catastrophic if it derails. Growth-oriented investors will love the momentum behind defense contracts and AI partnerships, but valuation-conscious ones might see it as buying a penthouse at peak prices. Practical tip: track earnings reports and federal contract news on Yahoo Finance. If you can ride out volatility, Palantir could be a thrilling addition to your portfolio. Now, let's talk AMD, a fierce competitor to Nvidia, carving out its own slice of the semiconductor world. In 2025, AMD's been making smart moves, partnering with KDDI on 5G networks, advancing with TSMC's N2 process, and rolling out their 5th-gen EPYC processors for Google Cloud. At CES 2025, they launched the Ryzen 9950X3D and 9900X3D chips, stirring major buzz. Argus Research praised AMD's growth despite macro headwinds, highlighting AI chip traction. Yahoo Finance reported Wells Fargo's bullish $140 price target, suggesting AMD could surpass Palantir's market cap by 2026. At the time of making this video, AMD trades at $96 with a $157 billion market cap. The trailing PE is 96.64, but the forward PE, based on 2025 earnings estimates, is a solid 21.91. TipRanks pegs AMD's one-year price target at $135, a healthy 40% upside, with analysts leaning buy. Though Nvidia leads, AMD is diversifying smartly with cloud and telecom partnerships. Supply chain risks persist, but AMD's operational efficiency provides a buffer. Practical step? Set a Reuters alert for earnings and TSMC news. Supply issues could be pivotal. Now on to Tesla, a story of turbulence and vision in 2025. Tesla's journey this year has been anything but smooth, yet remains deeply compelling for those willing to stomach volatility. In Q1, Tesla missed Wall Street's expectations. Revenue came in at $19 billion, missing the $21 billion consensus, and adjusted earnings per share fell short at 27 cents, versus the anticipated 39 cents. Automotive revenue declined by 20%, and deliveries dropped 13% year over year, Tesla's worst quarterly delivery performance to date, according to CNN. Multiple forces converged: fierce competition from Chinese electric vehicle manufacturers, mounting regulatory scrutiny, and growing backlash against Elon Musk's increasingly controversial public persona. On the earnings call, Musk unveiled ambitious visions: autonomous ride-sharing services rolling out in Austin by June 2025, and Optimus humanoid robots reaching commercial deployment by 2029. Bloomberg reported a subsequent 9.8% rally in Tesla's stock on April 25, fueled by optimism around relaxed U.S. autonomous vehicle regulations, corroborated by CNBC coverage. Tesla currently trades at $284, boasting a market cap of $917 billion, according to Yahoo Finance. TipRanks places Tesla's one-year price target at $289, but projections range wildly, from $115 to $465, reflecting profound uncertainty. Despite the allure, major institutions like J.P. Morgan and Bank of America have reduced earnings estimates while maintaining price targets, signaling cautious optimism. The forward PE ratio remains elevated, indicative of investors paying a premium for the prospect of future disruption, not current earnings. Risks abound. BYD and other Chinese automakers are eroding Tesla's market share, and declining deliveries could pressure margins further. But autonomy remains Tesla's wildcard. If Musk's vision materializes, Tesla could radically redefine personal transportation. What's your take on investing in Tesla right now? Drop your thoughts in the comments. I'd love to hear your perspective. For beginners, understand that a high PE is like paying today for a promise tomorrow. It demands faith and a long-time horizon. Practical advice? Closely monitor autonomy milestones and U.S. regulatory developments through Reuters and Bloomberg updates. For bold, risk-tolerant investors, Tesla offers asymmetric potential. For cautious investors, it demands extreme discipline. Now, let's move on to the next Magnificent Seven heavyweight, Alphabet, the digital titan behind Google. Alphabet's Q1 2025 earnings, released on April 24th, exceeded expectations. Revenue hit $90 billion versus a forecasted $89 billion, and earnings per share soared to $2.8, outpacing the $2 estimate, as reported by CNBC. Cloud services and AI-driven advertising were the engines behind this growth, and Bloomberg reports that Alphabet plans to invest an astonishing $75 billion in expanding its data center footprint. Yet, regulatory storms still swirl. On April 17th, a federal judge ruled against Google in an ad tech antitrust case, adding to Alphabet's complex legal challenges, according to CNBC. However, the strategic bet on quantum computing and AI infrastructure positions Alphabet at the forefront of technological evolution. Alphabet's stock stands at $162, with a market cap of $1.95 trillion. Analyst sentiment remains bullish. TipRanks forecasts a one-year price target of $203, with JP Morgan estimating $195. Alphabet's PE is 17.8, considered attractive for a mega-cap stock with robust growth drivers in AI, cloud, and advertising. Risks, such as Microsoft's aggressive cloud competition and regulatory penalties, are real, but Alphabet's diversification and innovation pipelines offset much of the threat. Alphabet remains a cornerstone for portfolios seeking both growth and relative stability. The projected 25.6% upside is a solid moderate growth expectation in a volatile tech landscape. Now we turn to Amazon, an empire unto itself. Under CEO Andy Jassy, Amazon is doubling down on AI, particularly through innovations like Novasonic, their proprietary AI model, keeping them competitive against Microsoft and Walmart. Amazon Web Services continues to dominate cloud infrastructure despite intensifying competition, while Amazon's retail operations leverage scale unmatched by any peer. Amazon stock currently trades at $189 with a towering market capitalization of $2 trillion. Projections suggest a one-year price target of $245, implying a 30% upside, supported by strong analyst consensus, rating Amazon a strong buy. The forward PE ratio is considered fair for a company straddling both hyper-growth sectors and mature retail dominance. In essence, investing in Amazon is like buying shares in an empire still expanding into new territories: cloud, AI, logistics, and healthcare. Finally, let's examine Apple, the most iconic brand in tech. Apple's 2025 innovation pipeline remains robust. The iPhone 16e, iPad Air with M3 chips, MacBook Air with M4, and iOS 18.4 updates are scheduled for release, according to Apple's newsroom. WWDC 2025, set for June 9th, promises even more surprises, possibly new AI services or expanded Vision Pro capabilities. While Samsung and Chinese manufacturers continue to erode smartphone market share globally, Apple's brand loyalty remains unparalleled. Apple's stock currently trades at $209, with a massive $3 trillion market cap, per Yahoo Finance. Projections point to a one-year price target of $236, implying a 12.9% upside. With a reasonable forward PE and continued revenue growth from services like Apple Music and iCloud, Apple remains a fortress of profitability. Think of Apple as buying into a trusted premium brand with near unbreakable customer loyalty. It's a relatively conservative tech investment compared to high volatility plays like Tesla or Palantir. Practical move? Track product launches and quarterly reports to stay ahead of major announcements. And so, if you're searching Best Tech Stocks 2025, or wondering, is Nvidia still a buy? This is your roadmap. Nvidia, AMD, Alphabet, Amazon, and Apple all present strong long-term buying opportunities. Nvidia and AMD offering AI-driven hyperscalers, while Alphabet, Amazon, and Apple provide powerful, stable platforms. Meanwhile, Palantir and Tesla offer high-risk, high-reward profiles for those seeking exponential upside at the cost of volatility. Yes, risks like geopolitics, regulatory shifts, and supply chain disruptions remain. Yet the underlying megatrends of AI, electric vehicles, and cloud computing are unstoppable forces. With the market facing uncertainty in 2025, a diversified, risk-aware strategy remains your best ally in unpredictable times. Track earnings, monitor macro risks, and always align investments with your personal risk profile, and the future could be yours to shape. If you found this video helpful, don't forget to hit that like button. It really helps the channel grow. Subscribe for more smart investing insights, and check out the other videos on the channel to keep building your financial edge. See you in the next one.